terms and conditions as every one of our other investors. Our friends, our family does. My parents obviously do. And then for us, we're lucky enough that investors are great, and having enough investors is not necessarily our issue. It's finding these projects. So it's not easy to find a good quality project that meets our return threshold, our margins, our risk profile every day. And that's why we turn down a lot, because it's not about how many we can do. It's about doing the right ones. Because we're putting in our own capital in every one of these deals, and that's what's important.
No, again, it's mind-boggling, but it's, again, nothing new. It's nothing unique. It's nothing sexy. This is just the way developers make money.
It is the way developers make money. I think it's unique for the people that get a chance to do it, because sometimes it's not even a money barrier.
Yeah.
It's if I didn't know you and I walked up to the street and said, "Hey, Rav, nice to meet you. I'm Peter. I got $1 million. Let's go start a business together." It's not necessarily true that you're going to do that. So it's not just having the monetary means to make a big investment. It's, will the personalities work? Will you want to be my partner? What opportunities are you exposed to? And the more that we get, closer we get with all these big developers, we see all their opportunities and the things they do. And then from our standpoint, we get to pick the best ones for ourselves and obviously our investors.
Yeah, and those investors are lined up. I mean, the deal that you did in Yorkville, $41 million, the money was raised in a couple of weeks. I actually got kicked out of a deal. I mean, I couldn't, because there's, again, 96%. So as one is exiting, it's almost like it's cash flow in a sense, because when you're in different deals, I'm in 6-7 deals right now, and so as it spits out money when the project finishes, you make money. It's almost like it's cash flow.
I get a lot of questions from people, and they ask me, what's the best deal? What would you do? And I tell everyone, it has nothing to do. If it's a Greybrook deal, in my opinion, it's always a phenomenal deal. And the returns are all generally the same, whether it's a townhouse project or a condo project. Obviously, the time horizons can be different. But I turn a non-cash flowing investment vehicle into a cash flowing investment vehicle. And I do that by saying, I'm going to invest in a 2-year deal, a 3-year deal, a 4-year deal, a 5-year deal, and another 2-year deal, another 4. And then as these deals finish, after putting money out for a couple years, they start turning and finishing, and every year I'm getting a check. So it's now passive. It's now cash flow is the wrong word, but it's consistent as far as distributions go.
Yeah.
And then you get to access and be part of a lot of different things, and own, frankly, plan all over the GTA.
Kevin O'Leary would be, would be very proud. You send out your dollars like they're soldiers, and they come back and they bring more with them.
Absolutely.
And so there's, like myself as well, I don't know why I did it, but a good friend of mine who's a financial advisor said, Rav, bring down your income, and you've got this room. So I threw $70,000 in RSPs, and when it turned into 40, I took it out, got taxed on it, put it in real estate, and made it all back quite quickly. For those that are watching and they've got money, Peter, in RSPs or TFSAs, Lira, that kind of stuff, RIFs, is there an opportunity there for people to invest?
Yeah, a lot of our projects, not all, but a lot of our projects are RSP, are ESP, TFSA, Lira, IPP eligible. So
there's IPP. What does that stand for?
It's individual pension plan.
Pension plan, yeah.
So essentially, at the end of the day, you can use your registered plans to invest in structure like this. Not every project is RSP eligible, and the only criteria, to be honest with you, is size. We need to have a certain size in order to make that physically possible. So the smaller projects, not always, but the bigger ones are eligible.
And it's funny, though, because a $10 million project might not be RSP eligible because of size. To Peter Politis and the Greybrook team, it's too small. we need it to be in the 30, 40. And so that's kind of what's exciting. This is the kind of numbers that we're playing with for as little as $25,000. I mean, I think that's really, really cool. When we come back from the break here, let's talk about the fourth question that we always ask. What is the risk, in real estate development? You're talking to Rav Toor and Peter Politis. We're learning how to make money in real estate developments. Don't go anywhere. Real Investments continues in a moment. Did you know that some of the largest developers in the GTA partner with individual investors to build housing? Partnering with investors allows developers the ability to do multiple projects at the same time. Yeah, Peter, going back to what we're talking about here in partnering, joint venturing with the developer, the first question that we always ask, what's the returns? And we can double our money every 3 to 4 years. I mean, the returns are 25% annualized. The second thing is, when do you get it? Well, we get it at the end of the project. If anyone says, hey, I'll give you, a little bit of cash in between, then we should be afraid, because where's it coming from? We wait till the end of the manufacturing of this deal. When people acquire it, like the resale, then we get paid. The third thing, what's the minimum? And you said the minimum to get in is anywhere from $25,000 to $150,000 is kind of the minimum, but you have investors that throw in $2-3 million. You know, it all depends on the project. The fourth question, which this is probably the thing that attracted me to Greybrook the most, is because of the full disclosures. You know, everything is laid out. Whenever we ask somebody, what is the risk? You know, they're kind of, well, there is no risk, or there, you know, and you kind of wonder, no, there's got to be something there. I appreciate always asking you that question. And whatever I do, you know, whether it's with my accounting, whether it's with, you know, I'm doing this, Peter, what do you think and what would be the downside of it? So when it comes to what we've been talking about here for 3/4 of an hour or so, what is the risk in partnering with the developer in these types of projects?
Yeah, I mean, that's a great question. Obviously, it's very pertinent. People sit there and say, well, there's got to be huge amounts of risk, and you guys have done all these projects and been successful, so either you're the luckiest guys in real estate or the smartest guys in real estate, and frankly, it's neither. At the end of the day, a lot of the risk that's associated with development comes with a few different ways. One is, you know, am I taking what I call a zoning risk or entitlement risk? The lands that we buy, they're not zoned industrial, agricultural, they're not farmland, they don't, I'm going to try to change the zoning. They're already zoned for residential inside of the official plan of our cities.
And that's huge, because we talked about it earlier on the show, that if not, then we don't know. You know, if I buy, you know, a granny's farm, or if I buy this and it's not ready to be built on, I could be waiting 2, 3, 4, 5, 6, 7, 8 years. I mean, right here in Mississauga, Brampton area, they said we're going to make basement apartments. People have been waiting years for that to become legalized.
Yeah, for sure. I mean, the time is obviously one of the risks associated with the kind of land that you buy. But also, I know how much of something I can build, really. I know I can build X number of townhomes or homes or condos, generally speaking. So we don't take what we call entitlement risk. Secondly, we buy stuff with what I call responsible leverage, which is little or no debt. I think the most debt we ever put on a property to date has been maybe 30% of the land, and it's either been Schedule I bank because there's income. So a lot of times we have a positive cash flow on our property, which means that no one can take it away. We as investors, we own that property, and we will develop it. So
if something cost $100 million, you're saying the most you've ever had debt on would be $30 million. You put down $70 million, you might have had 30. I mean, those are big numbers. But that's because there was something on that property until we demolished it that's giving you the income to service that debt.
Yeah, I mean, recently the acquisition that we had on the waterfront was a $60 million land buy. We bought that debt-free. We have a major tenant there in Federal Express, obviously.
Federal Express is renting it.
Is renting the
space. And I think it's like at $1 million a
Yeah, I mean, we have 7 figures of positive cash flow. So we as investors have bought an asset. We've bought it debt-free.
Let's not build on it. Let's just keep that money.
Yeah, I mean, yeah, there's a lot of options there, right? So at the end of the day, for us, is if you don't take zoning risk and you're not worried about making an interest payment every month or someone taking it away from you for carrying the property, someone's going to live in Yorkville, on the waterfront, in Liberty Village, in a townhouse in Markham or Woodbridge at some point. So then you introduce time, in my opinion, as being the biggest risk factor. So, you know, we've been very good about being on time. And the interesting thing is people assume that, well, if it takes longer, I'll make less money. My returns will go down. And that's a very common, in my opinion, misconception. Most people who buy real estate buy it for time, for it to appreciate over time. So if I'm selling a house on day one or I'm selling it a year or 2 years from now, the appreciation that you'll typically see in a normal course market will add a lot of profit to the bottom line. So time does not necessarily equate to a loss of profit.
You already mentioned this in Liberty Village. I mean, I think the project that's been the longest to date was Liberty Village, 6 years, and it's also been the highest return to date.
Correct.
So the highest return was with the one that took the longest time. Everyone made 41% annualized. So you're right. Even if it takes more time, land is going up, and that's where we make our money.
And that's really the thing. So if you sit there and say, I need this money back in 2 years or in 4 years, something bad will happen, well, you know what, maybe it's not for you. Maybe it's not a structure. Not that we think we're going to take longer, but nobody ever wants to be in that position. So for us, if I can sit there and buy a great asset, whether it's Yorkville, whether it's a townhouse project, on the waterfront in Liberty Village, College and Spadina, wherever our locations are, I'd be happy just to own that property. So if we buy stuff at a great price, we buy stuff in good locations, that's why we've always been able to make money, because our developers will be able to build at some point. Somebody will want to live in these areas at some point. And if time is my biggest risk, then you know what? I'm okay with that. And looking back to 08-09, which is, you know, we've had projects go through 08-09, yeah, sometimes we closed a sales center or we waited. But then we reopen back up, and instead of being forced to sell the property, try to refinance, lose the property, or we didn't get our zoning, like, we don't have those issues. So if I have to wait in a bad case scenario, it's better than 50% downside in the market, like a lot of people saw.
Okay, so basically what you're saying is, these don't sound like risks. These sound like, here's how we avoid the risk, because you're saying you're not buying something that's not ready to be zoned. So that therefore there's no risk.
Well, I mean, there's no risk from a zoning standpoint. The way I look at it is that if I identify the two biggest risks, it's really time and what I call illiquidity.
Illiquidity.
Yeah. So
meaning I can't take my money out right away.
Yeah, it's not a stock where you just, you take your mouse, you double click, all of a sudden the cash settles in your account 24 hours later, and off you go. Now, there are some stocks that aren't liquid at all because they don't trade very much. But that's really, to me, the two biggest risks. And if you, frankly, eliminate that time risk, sit there and say, I can't afford to wait as an investor, that's why the people who make money in real estate investing in the long run are ones with deep pockets, the ability to wait, because I have 2,000 years of history that says at some point in the future, my land and my house will be worth more then than it was before.
But, and you say that, and it's correct, but there's also, the people in this world that I respect the most, and I think we all need to, is our elders. Sit at the feet and learn from them about life, and I just love doing that. Peter, there's a lot of senior citizens that are in these deals. So it's not necessarily that we have lots of time, but they want that one more bump. They say, you know what, Peter, I want to give you this money for 4 or 5 years because I want to be able to double it just one more time. That's what I see since I've been involved with Greybrook for the last few years.
Yeah, one of the interesting things is that to us, it's an opportunity that touches a lot of different people in the demographic scale. Some people who are in the senior citizen catch, some people who are younger, as long as they have the financial means to do so. Some people who are planning for the next generation, for their heirs. At the end of the day, what people are really looking for is a stable place to make money. And a lot of people are not able to find good opportunities to make any return, let alone a decent return. And for us, we sit there and say, we think it's a place that makes sense for a lot of different people for a lot of different reasons, because you're buying a real asset, you're buying something that you can go to, drive to. You probably recognize the corner of real estate. You probably passed it half your life being around this city, and now you get to own that, and at some point we'll develop it, we'll build it, and we'll make our money from there.
I don't know. I think it's incredible. What people will say, and so I'm going to ask you this, but I know the answer, but I'm still going to ask you, because the answer is, well, Rav, is no one ever going to want to live there? But the question is, aren't we oversaturated? What happens if we build this thing up and then people don't move into it? Well, I already know it because you talked about the answer. You already said, well, we don't even build until we're 70, 80% sold out. But Toronto in general, Peter, supply, demand, coach us a little bit on that.
Yeah, a couple things. One, you mentioned in one of your comments when we were exiting from the break that Toronto's really an island like Manhattan and Tokyo. There's a legislative greenbelt on one side and the lake on the other. So over the last 20 years or 25 years, you've seen a lot of what's called urban sprawl, houses being built upwards. That's where Brampton, Mississauga, Richmond Hill, et cetera, Whitby came from. And for us, we sit there and say, that land has reached the greenbelt threshold, and that's why you're seeing condos go up in Brampton, in Mississauga, in Markham, in Milton. You're seeing if I told you 20 years ago that we're going to build a condo in Milton, I'd probably be behind bars, chained to some bed somewhere because you thought I was crazy. At the end of the day, for us, is that we have 100,000 illegal immigrants coming into this city a year. We need about 35 or 40,000 new residential dwellings, so building new homes, condos.
So say it again. So 100,000 people are moving into Toronto, GTA?
GTA.
So Toronto proper. Net numbers, like after people have moved out, 100,000 net people are moving in, and to sustain them, we need about 35,000 dwellings.
Yeah.
Okay, and so are we doing that? Or?
Yeah, so we're actually not really meeting. We've got about 10,000 what I call low-rise homes. So basically townhomes, homes that are being delivered every year, and the other 25,000 need to come by way of high-rise. Whether we like it or not, it's the new reality. And we're not building anywhere close to 25,000 condos in a year. So at the end of the day, we're actually not even meeting the demand for housing. And that's why you're seeing the rental rates. So those of you who have rental properties know that getting a tenant's not so complicated, and you have a lot of options, and frankly, the rental rates have been steadily increasing. The demand is there.
That's amazing. You heard it right here from Peter Politis. And Peter, basically he's saying 100,000 people moving in, and we're not building enough. If people want to get a hold of you, we're going to have your closing thoughts here. An hour's gone by. I always love hanging with you. We're talking to Peter Politis. I'm just flustered right now. We're talking about how to make money in real investments. Don't go anywhere. We'll be right back. Even though there are numerous cranes in the sky in the city of Toronto, 84% of all condos under construction are already sold. Builders do not even break ground until 70% of the units are sold. Hey, it's Rav. We're back. You've been watching Real Investments. We've been talking to my good friend Peter Politis about how to make money in real estate developments. If you missed the show, go to rogerstv.com, find the repeats this week, because it's been a fascinating show. Peter, it's always great to have you on the show. I can't wait to have you back in a couple months. But if there's just a few thoughts that you want to give the viewers at home with this whole concept of making money by joint venturing with a developer, what would you say to them?
Yeah, I mean, at the end of the day, it's important to understand the opportunities that are out there, both from a risk and a return profile, and matching it up to your own abilities and needs. So if anybody wants more information, you're free to contact us at Greybrook, meet with myself, my team, ask the questions, understand it. It's a new topic to a lot of people, but it's something that's been going around since the beginning of time. And if you can have the biggest and the best go to work for you every day, and really be the ones that are earning you capital and money, it's something that we feel is probably right for a lot of people. And we like to take advantage of what's going on in the city of Toronto. I mean, you've seen the Manhattanization. Yeah. We have vacancy rates at all-time lows at the end of the day, rental rates rising. So instead of being that guy who's waiting for the future increased prices and much higher returns on the development side, on the manufacturing side of the business.
No, I mean, and I think The Economist was saying that Toronto was rated, number 5 most livable cities in all of the world. Yeah,
I think it was number 4. I mean, we're routinely up there as far as people who want to live here, immigrants who want to come here. There's a lot of value in this city, and you've reached an inflection point where that land runs out, and this happens to be the opportunity in front of us today. I mean, if Bill Gates was born 10 years later, you might never have heard of him, but he took advantage of the opportunity in front of him, and that's what we're doing here. We're taking advantage of the opportunity of Toronto going, from here to here, becoming a world-class city.
Great stuff. Peter, thank you so much for being on the show.
Pleasure. Thank you.
It's always a pleasure to have you on.